Hi everyone! In today's video we're going to dive a bit deeper into protection policies and we're looking at income protection. Income protection used to more commonly be known as permanent health insurance because it covers essentially your health or if you have an accident or an injury and it means you can't go to work. It's important to note that redundancy and unemployment are not covered. Income protection is there to cover your income if you can't work because you are sick, you're injured, or you've been involved in an accident and you just can't do the work that you would normally do every day. And this is so important because each year more than 1 million people in the UK find themselves not being able to work because of this exact reason. So it's vital to make sure that you cover yourself for this scenario if you should ever encounter it. As the name suggests, income protection is all about your income. It doesn't really matter if you have children or dependents or anything else that you might need another sort of protection policy for. It's all about covering your income so that you can meet your outgoings if you're not able to go to work. Things like your mortgage or your rent, they're not going to stop just because you can't go out to work every day. So it's important to make sure that you can at least meet your minimum expenses if you can't go to work. You might have benefits your employer will continue to pay. You might have enhanced sick pay that your employer will offer you. And if you do, that's a really great benefit. But a lot of employees don't benefit from that sort of thing. And they have to deal with minimum income requirements from statutory sick pay, which doesn't actually last for that long. And it's really only a minimum amount that you would get paid. If you couldn't work for say 3 to 6 months or even longer than that, a year or 2 years, how would you be able to fund your expenses if you didn't have a protection policy in place to cover it? Do you have enough savings in the bank that could cover your monthly salary for 3 months or more? Especially if it's a long-term illness or injury that means you really can't go back to work and do the job that you were doing before. This is why income protection is so important. The key points of income protection to bear in mind are the following. First of all, it's not there to cover 100% of your income, because if it was to do that, why would you bother going back to work? So generally, income protection policies cover 50% to 75% of your income. So it's enough to help you get by if you cut back on your leisure spending and your other expenses, but it's enough to help cover your mortgage, your rent, your council tax and your other bills, but still gives you the incentive to go back to work so that you could actually get 100% of your salary again. So it gives you a minimum amount that you could get by on if you had to. Another thing about income protection, if you take out a long-term income protection policy, which is generally the type of income protection policy you would take out, this would pay out until either you go back to work, you retire, or the policy comes to an end. Now, if you happen to have a long-term injury or sickness that means you encounter it at age 30, but you actually can never go back to work, it would keep paying out until you retire or the policy comes to an end. Or if you die, if it happened to happen first. How else would you meet your expenses for that longer term, say 30 years or more? It would pay out those basic expenses for you if there was no way you could go back to doing your job. The important thing to know about income protection is that it generally has a deferred period built in. Maybe it's 3 months or 6 months, but this means that the policy won't pay out until those 3 months or those 6 months have passed. So you really should have some savings set aside to help cover you for those number of months before the income protection will kick in. The longer the deferred period, the cheaper the premiums, because you have to wait longer until they will pay out, and it's likely if it's a 6-month deferred period that you may well be up and running and back at work before that period ends, in which case the provider doesn't have to pay out. But you have to be realistic, and if you really don't think you could last longer than 3 months, say, with any savings that you have, then make your deferred period 3 months or less. Although this can make your premiums a little bit more expensive, it will be worth it in the long run. So just be realistic when you're setting these things up. Income protection tends to cover most illnesses and sicknesses. Each policy and each provider offers slightly different things, so it's important to check the terms and conditions of each policy when you're setting it up, especially if you're concerned about something in particular, or if you have a history of something in your family, then make sure that is covered before you take the policy out. The other great thing about a long-term income protection policy is you can claim as many times as you like. You might happen to suffer an illness or then be involved a couple of years later in an injury and have to claim on 2 different occasions. But that doesn't matter. The income protection policy should still pay out on that second claim or even a third or a fourth claim. There's no limit really to the amount of claims that you can claim with an income protection policy, so long as you meet their requirements for a valid claim. Now, there are some circumstances where you may well not need income protection, and what would they be? Well, as I said before, if your employer offers income protection or some form of benefit in that regard, then you don't necessarily need to take out any form of income protection. But it's a good idea to check how long that benefit would be paid for, because when your employer's sick pay drops off, it's a good idea to have your deferred period ending for your income protection, and then that can kick in and take over from the sick pay your employer was paying you. Another reason you might not need income protection is if you actually think you can survive on the statutory sick pay provided by the government. This is £94.25 per week, and it's paid for a maximum of 28 weeks. But there are caveats, so make sure you know what they are and if and when they would apply to you. Now, a lot of people couldn't survive on £94 a week, so it's worth thinking of what your budget is and what your expenditure's like and seeing if you think you could survive on that amount. If not, then you should think about taking out an income protection policy. Another reason you might not need income protection is you actually have a good amount of savings set aside somewhere, so perhaps 6 months of salary or even more than that. And if you do have that set aside, then you either don't need income protection, or you should set a policy up, but with, say, a 6-month deferred period, so that you know your income's going to be covered by your savings, and then the income protection policy can kick in after that. If you don't have this level of savings saved up, then an income protection policy can have affordable premiums that would be preferable, rather than having to rely on savings that you don't necessarily have. Really, the last thing that would mean you wouldn't necessarily need an income protection policy is if you have friends or family that actually would be able to help you out. But that puts a lot of reliance on people that you might not necessarily want to be dependent on. And if that might be for the long term, how would you feel if your family or your friends had to end up supporting you for a long period of time? So that's just something to think about. If you don't want to have that dependency on other people, then income protection is another thing you can do. The cost of income protection varies widely depending on what sort of policy you take out. Now, I've spoken mainly about long-term income protection, and that really is the most sort of comprehensive type of policy you can have. But you can take out short-term policies, but they will only pay out for, say, 12 months or 24 months, and after that time, the income comes to an end. So if you still can't go back to work, where are you going to get your money from to meet your expenses? They are, however, cheaper, and if it's a toss-up between no income protection and a short-term income protection policy, it's better to have something rather than nothing, so definitely explore that option. Now, the premiums are dictated by several factors that relate to you, to your age, to your health, to your lifestyle. Are you a smoker? Do you drink a lot? It also depends on what kind of job you do. There are riskier jobs than others. There are more physical jobs than others. So that can have an effect on the premiums as well. Also, the percentage of your income that you want to cover can affect the premiums, as can any medical history or family history. That can have an impact on the premiums too. The deferred period makes a difference, as I mentioned before. So the longer the deferred period, the cheaper the premiums will be, but you need to make sure you've got yourself covered for those months. One thing that you might have heard of is critical illness cover, and why should you have income protection and critical illness cover? This really comes down to one key element, and that's how those policies are paid. Income protection replaces your income, so it's paid to you on a monthly basis, as generally your income would be. But a critical illness policy, though it does pay out for illnesses, if you suffer a terminal illness or a qualifying illness, you will get paid a lump sum amount rather than a regular income. Also, once a critical illness policy pays out, it comes to an end. It cannot be claimed on again. And if you have a critical illness and life cover combined, it will only pay out on one event, either a critical illness claim or a life claim. Whereas an income protection policy, one of the long-term policies, as I said earlier, you can claim on that numerous times, and because it's paid monthly, you're not left dealing with a lump sum that you perhaps might spend all at once or not use it in the best way possible. So something to consider when you're looking at covering yourself. You can certainly look on comparison sites if you want to do a bit of discovery yourself, but generally these don't give you the best options. They might not have all the providers on there, and generally the comparison sites only choose the policies that they understand. An IFA, on the other hand, can look at the whole of the market and look at each offerings of each provider and each policy, especially if there are niche things that you perhaps want to be considered. So if you want to talk to me about income protection or any other form of protection policies, then let me know. Subscribe to the channel, have a look at my other videos. I have spoken about protection before, so check those out. And otherwise, I'll see you in the next one.